Hi everyone, welcome to the Eagle Finance channel. In this video let us discuss about the possible frauds in the financial statements of the company. Understanding the quality of the corporate governance of company is important before investing in it. Sweep is to collect all the cash the company had for operations and show it as income. For example, money to be paid to workers, bank balances are summed up and showed as income in profit and loss statement. This cash is an expense that has to be given to suppliers or workers in the specified accounting period. Notes given to other income row has to be studied carefully in which we can understand the money flow. Scam 2, Understating Expense. Expense on any fixed asset has to be distributed through the lifetime of the product. For example, company bought a machine worth 80 crores and as per industry standard that machine lifetime is 8 years. Hence expense has to be 10 crores each year for 8 continuous years in the profit and loss statement. If company calculations show that machine lifetime is 10 years, expense in each year becomes 8 crores. Hence by this move company can show 2 crores extra profit. Just by increasing lifetime of the asset from 8 years to 10 years company can show 2 crores additional fake income.
The term related party transaction refers to a deal or arrangement made between two parties who are joined by a pre-existing business relationship or common interest. Companies often seek business deals with parties with whom they are familiar or have a common interest. Although related party transactions are themselves legal, they may create conflicts of interest or lead to other illegal situations. Public companies must disclose these transactions. Following are the examples. Loans to promoters at less than market rate. Companies can give huge loans to promoters at very less interest rate. Write-off loans to promoters. If listed company promoters have another private entity and it takes loan from the listed company, the promoter is diverting cash to his own personal business. These kinds of loans cannot be written off under bad loans. Loans from promoters at higher than market rate. If a promoter wants to give a loan to a listed company, he can charge more than market interest rate. Security deposits to promoters. Let us say the company wanted to rent a place for its business operations. It gives some 100 crore deposit and 1 crore as rent every month to the promoter. Promoters can buy that place with 100 crores and rent it to the company. Deposits for any site should not be more than 5 to 7 times the monthly rent. Competing business by promoter. If a promoter owns a private company which is into the competing business of a listed entity, then the promoter can route the business/customers to his private company instead of the listed company. Guarantee to lenders on behalf of promoters. Listed companies can act as guarantee for loans taken by private companies owned by promoters. If a private company fails to repay the debt, then the listed company has to pay it. This is a big negative for common stakeholders of listed companies. Scam 4, overstating the sales by recording future expected sales. Some companies are too aggressive at recognizing revenue. For example, if a customer provides an advance on future services, you should carry this as a liability in the unearned revenue account, not as sales revenue. You should not recognize revenue based on anticipated sales or unshipped goods. If trade receivables are more along with high inventory, then the company is recording future sales.
Scam 5, Understating the expenses by capitalizing operating expenses. As discussed earlier, expenses because of fixed assets can be capitalized, spread over the lifetime. Operating expenses should not be capitalized over any time period. Some companies can capitalize the operating expense to show more profits in the profit statement. For example, due to rise in fuel price, companies end up spending 10 crores extra. This 10 crores is operating expenses during the specific financial year. This expense cannot be split to 1 crore each year for the upcoming 10 years. Scam 6, hiding obligations from balance sheet. Start with assets. Revealing undisclosed liabilities and risks begins with assets. For each asset, it's important to evaluate what could cause the account to diminish. For example, accounts receivable may include bad debts, or inventory may include damaged goods. In addition, some fixed assets may be broken or in desperate need of repairs and maintenance. These items may signal financial distress and affect financial ratios just as much as unreported liabilities do. For example, a company may forget to accrue liabilities for salary or vacation time. Alternatively, management might underreport payables by holding checks for weeks or months to make the company appear healthier than it really is. Other detection methods to find frauds. The ratio miscellaneous expense to total revenue should not be much higher than industry average. Huge changes in reserves is one of the indications for misdirecting the cash. Methods of calculations of depreciation should not be changed. Generally, companies try to increase the lifetime of assets in these calculations. Bad debt expense is the money that someone owes to a company, but it is written off due to several reasons. This expense should be less compared to industry standard. Sudden increase in bonuses and incentives signify that cash is leaking somewhere. Some companies replace auditors more often than industry standard. During this time, companies can skip reporting to regulatory bodies for 1 quarter. This time period might be used to manipulate numbers. Grow revenues without substantial increase in cash flows could be another instrument. Revenues are easy to manipulate but harder to manipulate cash flows. Comparing the percentage increase in both of them can give an overview of the corporate governance. Inflating assets and net worth is another common move. If any fixed asset like land owned by a company might be valued at 10 crores, for example, they can report the value of that asset as 15 crores. This will lead to an increase in the net worth of the company. If industry is facing pricing pressure, the company maintains consistent growth profit margins, then care has to be taken while evaluating the company. The effects on the industry generally spill over all the companies in that industry. Auditors are able to detect the frauds, but bribing may clear it off. If the books are cooked for once, it becomes a vicious cycle and I need to cook the books every single year. All these above observations do not guarantee fraud, but need extra attention.